which financials in what parts of the global market you're overweight, given that, of course, here in the U.S., we're now starting to see the fallout from not only rising rates and concerns about this sector, but also just broad competition in the sector.
In our Asian model portfolio, we have allocations both to the Chinese banks, a combination of the SOE banks and the retail-focused banks over there, the Indian private sector banks, and the Korean and Singaporean banks. So in case of Asia, the increasing interest rates, and we have seen this in Korea and some other pockets of Asia, leads to net interest margin expansion. And we think that story, while possibly in the last leg, is still alive. In some other parts of the world, particularly in India, the private sector banks are the biggest beneficiaries of market share expansion and a very strong credit growth environment that has emerged over the past 1 year. It's running at about 16 to 17%. Corporates are underleveraged in much of Asia, barring possibly a few pockets in Greater China. So I think it's a combination of all these considerations that lead us to be overweight financials. And we think that despite what's happening in the developed markets, and this concern on interest rates is likely to stay with us for a while, I think this bet of ours is likely to stand us in good stead.
Do you think what's happening here in the U.S. could pose a systemic risk to the sector?
I think the risk on the rates being much higher for longer, one systemic risk that it poses to the emerging market is channelized through the currency, because it means that the US dollar could also appreciate more. We could even reach, kind of a dollar shortage environment that we had a few years ago. And that obviously is not good for the emerging market universe, particularly those markets within Asia which are dependent on external capital inflows for their balance of payments. So I think that's a risk that Asian emerging market investors would have to be mindful of.
Manishi, when you take a look at it perhaps from a different point of view, the fact that we're seeing, of course, this as a result of the outsized exposure SVB has to broader tech and VCs and funding within VCs drying up, is this potentially a sign that we're starting to see recessionary conditions across some major contributing sectors to the broader economy already?
Inversion of the yield curve, much higher interest rates than the market currently anticipates today. Even very high inventories across certain sectors, and particularly the tech hardware. These are pointers to a likely demand compression, a demand contraction in the developed markets. And this is something emerging markets will have to contend with, because much of these Asian emerging markets are exporters, where the final demand rests in the developed markets. And, even if we do have a technical recession, which, even we have been talking about, starting from Q3 in the United States, it would certainly have an impact on the exporters of the emerging markets. But having said this, if I look at the earnings estimate trajectory in much of these sectors which get impacted, I think they're possibly in the last leg of their earnings decline. Earnings estimate declined, the trajectory that they followed. So, I would think that the first half of this year would be turbulent for Asia. We would have a relatively calmer second half.
Interesting as we're seeing so much downside pressure when it comes to rate-sensitive sectors like tech, but your top pick is actually Chinese tech.
Right. And that clearly dovetails with China's reopening, where we think that this whole consumer discretionary or the improvement in consumption sentiment has an impact on e-commerce, internet, and other social media in China. We have already seen that. These stocks actually skyrocketed since late October, early November. Many of these are understandably taking a breather. But some of these, even in our valuation screens, they're showing up as reasonably valued stocks now. their valuations are possibly in the mid-teens PE over a 1 year forward or 2 year forward. And at the same time, their earnings estimates after the kind of hiccup that we have seen over 21 and 2022 are likely to stabilize with improving consumption sentiment. And that's one of the, the strongest background reasons. That's the tailwind that we see for these stocks going forward.